There is a single, silent destroyer of fortunes in the stock market. It's not market crashes, it's not picking the wrong stocks, though that certainly doesn't help. It is a quiet, seemingly prudent, and widely celebrated act of financial self-sabotage. It's the decision to sell your winners. The moment you click that button, locking in a tidy 50 or 100% gain, you may feel a rush of satisfaction, a sense of cleverness. You've beaten the market, you've taken your profits off the table. But what you have likely just done is sell the winning lottery ticket for the price of a bus ride home. You have cut the one flower in your garden, capable of growing into a mighty oak, and you will now spend the rest of your investing life watering weeds. This is the great paradox of wealth building. The very act that feels safest, taking profits, is the one that guarantees you will remain financially small. It is the single biggest barrier between the amateur investor and the achievement of true financial independence. The millions, and in some cases billions of dollars that slip through the fingers of investors are not lost to bear markets. They are forfeited in bull markets. They are given away willingly, exchanged for the fleeting comfort of a small, realized gain. Warren Buffett, the man who built a $100 billion empire from the textile mill ashes of Berkshire Hathaway, has constructed his entire philosophy around preventing this single, catastrophic error. His most profound secret is not a formula for picking stocks, it is a rule for holding them. A rule that, once understood, reframes your entire relationship with the stock market, with business, and with the very nature of wealth itself. The principle is deceptively simple. The best time to sell a truly wonderful business is almost never. This isn't just a folksy aphorism from Omaha. It is a mathematical and psychological sledgehammer. It is the core code that allows the magic of long-term compounding to perform its life-changing work. It is the difference between making a living from the market and building a dynasty with it. Over the course of our journey today, we will dissect this principle into its 5 core pillars. We will not just talk about it, we will install it into your operating system. You will learn not only why you must hold on, but how. You will develop the fortitude to navigate the storms of volatility and the discipline to resist the siren song of easy profits. This is the financial education that separates the millionaire mindset from the crowd. This is the final promise of investing, that by doing less, by resisting the urge to act, you can achieve vastly more. We begin with the engine room of this entire philosophy, the force that Buffett harnessed to become one of the wealthiest people in human history. It is a power our brains are not wired to comprehend, a force that operates on a timescale that defies our intuition. This is the unseen, almost mystical power of infinite compounding. To understand it is to understand why selling a great business is not just a tactical error, but a violation of the most powerful law in the financial universe. For this, we must travel back to 1972, to a decision that would forever change the course of Berkshire Hathaway and cement the cornerstone of Buffett's evolving investment strategy. He and his partner, Charlie Munger, were presented with an opportunity to buy a company called See's Candies. On the surface, it seemed to violate every rule they had learned from their mentor, Benjamin Graham. Graham's school of thought, deep value investing, was about buying statistically cheap businesses. It was about finding companies trading for less than their liquidation value, what he called buying dollars for 50 cents. It was a quantitative cigar butt approach to investing. Find a discarded cigar butt on the street with one free puff left in it, take that puff, and then throw it away. See's Candies was no cigar butt. The company, a beloved West Coast chocolatier, was being offered to them for $25 million. This price was 3 times its book value. For a devout Graham disciple, paying such a premium was heresy. Buffett's initial reaction was to walk away. $25 million was a significant sum for Berkshire at the time, and the price seemed far too high. It was Charlie Munger who pushed him. Munger argued that they weren't just buying assets, the stores and the inventory. They were buying something intangible, something far more valuable, a brand that commanded immense pricing power in the minds of its customers. People didn't just buy See's candy, they felt a deep emotional connection to it. For birthdays, for holidays, for apologies, a box of See's was the automatic, unthinking choice for millions. This meant See's could raise its prices year after year without losing customers. And it didn't require massive capital investment to grow. It was, in Munger's words, a business that gushed cash. After much deliberation, they paid the $25 million. It was one of the most important decisions in Berkshire's history. That initial investment, which seemed so expensive at the time, would go on to generate, cumulatively, over $2 billion in pre-tax earnings for Berkshire Hathaway. $2 billion from a $25 million purchase. And all of that cash could then be redeployed into other wonderful businesses and investments. See's Candies became the prototype. It was the crucial lesson that shifted Buffett from buying fair businesses at wonderful prices to buying wonderful businesses at fair prices. But the deeper lesson, the one that underpins our entire discussion, is what he did next. Nothing. He never sold it. He recognized that See's wasn't just an asset to be bought and sold. It was a machine. A compounding machine. Each year it took in its earnings, and, because it required so little capital to operate, it could send nearly all of its profits to Omaha for Buffett to allocate. Selling it, even for a huge profit of, say, $100 million a few years later, would have been an act of profound financial ignorance. It would have been like selling a goose that laid golden eggs every year, simply because someone offered you a good price for the goose. The value wasn't in the goose, it was in the endless stream of golden eggs. This is the essence of infinite compounding. A truly great business is not a static object whose value you are trying to guess. It is a dynamic system that actively, relentlessly increases its own intrinsic value over time. Selling it means you not only forfeit all future growth, you also have to find something even better to do with the money. A task that becomes harder and harder as your capital base grows. The See's Candies story is the foundational anecdote for the entire buy and hold philosophy. It taught Buffett that the real money, the life-changing wealth, is not made in the buying or the selling, it is made in the holding. It is made by identifying a compounding machine and then having the wisdom and patience to just let it run. The reason this lesson is so difficult for most people to internalize lies deep within our cognitive architecture. The human brain is a marvel of evolution, but it was designed to survive on the African savanna, not to thrive in the world of exponential finance. We suffer from a profound and pervasive cognitive flaw known as exponential growth bias. Simply put, our minds think in straight lines. We are linear processors in an exponential world. If I ask you to calculate 8 plus 8 plus 8 plus 8, you can do it with relative ease. If I ask you to calculate 8 times 8 times 8 times 8, your intuition breaks down almost immediately. This is the difference between arithmetic and geometric progression, and it is the key to understanding why we consistently undervalue the act of holding. When we see a stock double, going from $10 to $20, our linear brain registers a $10 gain. We think, great, I've made $10 per share. If I hold, maybe it will go to 30, and I'll make another 10. We see the future as a simple extension of the past. What we fail to grasp is the nature of the engine we are sitting on. A business that grows its earnings at, say, 15% per year is not adding a fixed amount of value each year. It is multiplying its value. In the early years, the difference is barely noticeable. A $100,000 investment growing at 15% becomes $115,000 in year 1. A nice gain. In year 2, it becomes $132,000. Still good. Our linear brain sees this steady progress and thinks it understands it. But the magic is happening beneath the surface, silently and invisibly. After 10 years, that $100,000 is now over $400,000. After 20 years, it's over $1.6 million. After 30 years, it's $6.6 million. By year 40, it is over $26 million. The gains in the later years absolutely dwarf the gains in the early years. The curve sweeps upward into a trajectory that our Savannah-honed intuition simply cannot process. This exponential growth bias is why selling a winner after a double feels so right. We have locked in a 100% gain, a tangible, easily understood achievement. We cannot emotionally or intuitively grasp that we may have just forfeited a 10,000% gain that was waiting for us on the other side of time. We sell because the linear part of our brain, the part that controls our gut feelings, screams that this is a good deal. It cannot compute the opportunity cost. It cannot see the explosive, world-altering power of the steepening curve. Understanding this bias is the first step toward defeating it. You must accept that your natural intuition about long-term growth is fundamentally broken. You cannot trust your gut. You must trust the math. The real work of wealth building is not in the frantic activity of trading, but in the quiet, disciplined patience of letting the unbreakable mathematics of compounding do its work on your behalf. So how do we override this flawed mental wiring? We need a practical tool, a mental model that forces us to see the world not as it appears to our linear brains, but as it truly is, exponential. Let's call this model the compounding canvas. It's a visualization exercise, a blueprint for transforming your investment strategy from short-term speculation into a long-term plan for financial independence. The first step is to stop thinking in terms of stock prices and start thinking in terms of business earnings. A stock price is just a fleeting opinion. The underlying earnings power is the reality. When you analyze a company for a potential long-term investment, your primary task is to estimate its sustainable earnings growth rate over the next decade or more. Let's say you identify a wonderful business, a modern-day See's Candies, and you conservatively estimate it can grow its earnings per share by 15% annually. Now take out a literal or metaphorical canvas. In one corner, write down your initial investment. Let's say it's $10,000. The next step is to ignore the next 1, 2, or even 5 years. That timescale is a trap for your linear brain. Instead, you must project forward in increments of decades. This is crucial for your retirement planning and overall wealth building. Use the rule of 72 as a starting point. To find out how long it takes for your money to double, you divide 72 by the growth rate. In our case, 72 divided by 15 is approximately 4.8. So this business, and by extension your investment, is doubling in value roughly every 5 years. Now let's paint the canvas. At year 0 you have $10,000. At year 5 you have $20,000. At year 10 you have $40,000. At year 15 you have $80,000. At year 20 you have $160,000. At year 25 you have $320,000. At year 30 you have $640,000 from a single $10,000 investment. Now step back and look at that canvas. The growth in the first 5 years was $10,000. The growth between year 25 and year 30 was $320,000. This is the picture your intuition could never paint on its own. This is the power of compounding made visible. The third step of the compounding canvas model is to anchor your decisions to this long-term picture. When the stock market crashes and your $10,000 investment temporarily falls to $7,000, do not look at the ticker, look at your canvas. Ask yourself one question. Has anything happened to permanently impair this company's ability to grow its earnings at 15% per year for the next 30 years? If the answer is no, then the price drop is a gift, a temporary sale on a masterpiece. If the answer is yes, then your thesis is broken and you should sell. But notice how this reframes the decision. It's no longer an emotional reaction to a scary price drop. It is a rational, business-focused assessment of your long-term compounding canvas. This mental model is your shield against the folly of short-term thinking and the flawed programming of your own mind. It is the practical application of Warren Buffett's advice, a blueprint for achieving extraordinary portfolio growth. To fully appreciate the wisdom of this approach, we must spend some time exploring its opposite. We must walk the path of the 99%, the path littered with broken dreams and mediocre returns. This is the path of the lotto ticket mindset. The vast majority of people who enter the stock market do not see themselves as part owners of businesses. They see the market as a grand casino, a place to place bets. They are not investing. They are gambling on squiggly lines on a screen. Their entire focus is on short-term price action. They search for stocks that are about to pop. They chase hot tips from friends or so-called gurus on social media. Their investment strategy is built on hope and hype, not on a sober analysis of long-term business fundamentals. This mindset completely blinds them to the real engine of wealth, the internal compounding of value within a great company. They see a stock that has gone up 100% and think, "I missed it." The follower of Buffett's philosophy sees that same stock and thinks, "This business is proving its strength, it's a winner. Let me investigate if its competitive advantages are still intact for the next 20 years. The lotto ticket mindset leads to a constant churn of activity. Buying, selling, chasing the next hot thing. This behavior feels productive. It feels like you are doing something, taking control of your financial destiny. In reality, it is profoundly destructive. Every time you sell a stock to chase another, you incur transaction costs. You incur taxes, slicing away a piece of your capital that can never compound for you again. Most importantly, you are constantly resetting the compounding clock. You jump from one slow-moving train to another, never staying on one long enough for it to reach its exponential acceleration phase. The 99% are stuck in the flat, early part of the compounding curve, hopping from one to another, while the patient investor stays on a single, powerful locomotive as it begins its steep ascent. The tragic irony is that the lotto ticket chaser is often working much harder, spending hours watching charts, reading news, and stressing over daily fluctuations. The buy-and-hold investor, the owner of a wonderful business, can spend their time reading annual reports, playing bridge, or simply living their life, secure in the knowledge that their capital is being patiently and relentlessly compounded by a superior business. The path of the 99% is a frantic, expensive, and ultimately futile sprint. The path of the compounding-aware investor is a calm, deliberate, and ultimately life-altering marathon. The difference between these two paths isn't just philosophical, it manifests in brutal, tangible financial reality. Let's connect this directly to your wealth-building journey. The core distinction is between arithmetic and geometric returns. The lotto ticket mindset chases arithmetic returns. I bought at $10, I'll sell at $20 for a $10 gain. The owner's mindset cultivates geometric returns. I bought a business that grows at 15% a year, and I will let that percentage compound upon itself for decades. The difference in outcome is not small. It is astronomical. Imagine two investors, both starting with $100,000. Investor A, the trader, is quite skilled. They manage to generate a 20% return every year. But at the end of each year, they sell their winners to lock in gains and pay a short-term capital gains tax of, let's say, 35% on their $20,000 profit. That's a $7,000 tax bill. Their net gain is $13,000. They start the next year with $113,000. They are making money and they feel smart. Investor B, the owner, finds a wonderful business that also compounds its value at 20% per year, but they don't sell. Their $100,000 grows to $120,000 in year one. In year two, it grows to $144,000. They pay no taxes because they haven't sold anything. Let's fast forward 30 years. Investor A, the skilled trader, despite their annual success, has been fighting a constant battle against taxes and the need to find a new 20% idea every single year. Their portfolio, after 30 years of diligent effort, would be worth approximately $1.4 million. A fantastic result, far better than most. But now look at Investor B. By simply buying one great asset and holding on, allowing their returns to compound tax-deferred, their initial $100,000 has grown to nearly $23.7 million. That is not a typo. Over 17 times more wealth, with a fraction of the effort, stress, and activity. This is the direct financial connection. This is the devastating cost of ignoring the power of infinite compounding. The relentless drag of taxes and the constant resetting of the compounding clock is a guaranteed anchor on your portfolio growth. The decision to not sell, to let a great business run, is the most powerful and tax-efficient investment strategy ever devised. It is the mathematical secret to building generational wealth and achieving a level of financial independence that active trading can never hope to match. Of course, the entire principle hinges on one crucial phrase: a truly wonderful business. The mandate to never sell is not a license to hold on to mediocrity. It is a privilege reserved for the rarest of corporate species. Applying this rule to a low-quality, speculative, or competitively disadvantaged business is a recipe for disaster. Therefore, the second great pillar of this philosophy is mastering the art and science of identifying these exceptional companies in the first place. You must become a connoisseur of corporate quality. This is the discipline of stock analysis, not through the lens of a short-term trader looking for a pop, but through the eyes of a long-term partner seeking a business to marry. The perfect illustration of this principle can be found in Buffett's investment in the Washington Post Company in the early 1970s. This was not a calm period in the markets or for the company. The nation was reeling from the Watergate scandal, which the Post had broken, and the stock market was entering a brutal bear market that would last from 1973 to 1974. The Washington Post stock, caught in this perfect storm of market fear and uncertainty, was plummeting. Wall Street was terrified of potential government retribution over the Pentagon Papers and Watergate reporting. The prevailing wisdom was to stay away. Buffett, however, saw something different. He wasn't looking at the scary headlines or the falling stock price. He was analyzing the business itself. He had long been a student of the newspaper industry and understood what made a dominant paper in a major city a truly spectacular business. He called it an economic franchise. In his mind, the Washington Post had a near monopoly on information in the nation's capital. If you were a department store in Washington, D.C., and you wanted to advertise a sale, you had no real choice but to put an ad in the Post. If you were a citizen of D.C. and wanted to know what was happening in your city with your government, you had to read the Post. This gave the company tremendous, almost automatic pricing power. They could raise their advertising rates year after year, and their customers had to pay. Furthermore, the business required very little capital to grow. It was a cash machine. Buffett calculated that the entire company was being valued by the stock market at around $80 million. He knew from his deep industry knowledge that he couldn't replicate its competitive position for 5 times that amount. He saw a wonderful business, an economic fortress, being offered at a ridiculously cheap price because of short-term fear. So in 1973, as the market was crumbling, he began to buy. He invested nearly $11 million, acquiring a substantial stake. Then he held. He held through the stagflation of the 70s. He held through the crash of 1987. He held through the dot-com bubble and bust. He held for over 3 decades. That $10.6 million investment grew to be worth over $1 billion. It was more than a 100-bagger. This wasn't luck. It was the result of a 2-step process. First, the rigorous, unemotional stock analysis to identify a truly wonderful business with a durable competitive advantage. And second, the unwavering discipline to hold that business for an extraordinarily long period of time. He bought the moat, not the story. He bought the franchise, not the stock chart. And by refusing to sell this masterpiece, he allowed the power of compounding to work its incredible magic for Berkshire's shareholders. profoundly influencing his entire approach to asset management. What allowed Buffett to make such a bold move and, more importantly, to stick with it for decades? The answer lies in how he harnessed certain psychological principles that usually work against investors. Two of the most powerful are the endowment effect and confirmation bias. The endowment effect is our tendency to overvalue something simply because we own it. A coffee mug you own suddenly seems more valuable to you than an identical one on the shelf. In investing, this is often dangerous, leading people to cling to bad investments. But Buffett flips this on its head. By doing such intense research before dokes buying, by truly understanding the business as if he were going to own the whole thing, he develops a justifiable and powerful sense of ownership. He's not just buying a ticker symbol, he's buying the Washington Post. This deep sense of endowment makes him reluctant to part with it for trivial reasons, like a market downturn or a quarter of bad earnings. It becomes part of his psychological portfolio, a cherished possession. Then, confirmation bias kicks in. This is our natural tendency to seek out and favor information that confirms our existing beliefs. Again, for the average investor, this is a path to ruin. They buy a speculative stock, and then only read articles and forum posts that tell them it's going to the moon, ignoring all contrary evidence. Buffett, however, builds his confirmation bias on a foundation of reality. His initial belief is not, "This stock will go up." His initial belief is, "This company has a durable competitive advantage." So, his version of confirmation bias involves constantly looking for evidence that the moat is widening. Is the newspaper circulation share increasing? Are advertisers still dependent on them? Is their brand growing stronger? As long as he finds evidence confirming the strength of the underlying business, the day-to-day fluctuations of the stock price become irrelevant noise. He has effectively weaponized these cognitive biases in his favor. He creates a powerful psychological anchor, not to the price he paid, but to the quality of the business he bought. This allows him to act with the conviction and patience that the 99% can never muster. They are anchored to price and fear. He is anchored to business quality and facts. This psychological framing is the secret to developing the fortitude to hold a wonderful business not just for years, but for a lifetime. To build this kind of conviction, you need a systematic way to evaluate businesses. You need a mental model for identifying these economic fortresses. Let's call it the 4 pillars of the economic moat. This is your blueprint, your checklist for serious stock analysis, a core component of any robust financial education. Before you invest a single dollar for the long term, you must be able to clearly identify which of these 4 pillars, or ideally, which combination of them, protects the business from competition. Pillar 1. Intangible assets. This includes things like brand names, patents, and regulatory licenses. Think about Coca-Cola. The brand itself is a monstrous intangible asset that allows them to charge more than a generic cola. A pharmaceutical company with a patent on a blockbuster drug has a government-granted monopoly for a period of time. This is a powerful, though often temporary moat. Pillar 2. Switching costs. This is when it is too expensive, time-consuming, or risky for a customer to switch from one product to another. Think about the bank where your direct deposit goes and all your bills are paid automatically. The hassle of switching all of that over is immense, even if another bank offers a slightly better interest rate. Enterprise software companies are masters of this. Once a corporation has trained thousands of employees on a specific software suite, the cost and risk of switching to a competitor are astronomical. Pillar 3. Network effects. This is when a product or service becomes more valuable as more people use it. The classic example is a social media platform like Facebook or a credit card company like American Express. The value for a new user is the existing network of billions of other users. The value for a merchant in accepting American Express is the network of millions of high-spending cardholders. This creates a powerful feedback loop where the winners get stronger and stronger, creating an almost impenetrable moat. Pillar 4. Cost advantages. This is when a company can produce a product or service at a significantly lower cost than its competitors. allowing it to either have higher margins or undercut everyone on price. This can come from proprietary processes, superior scale, like Amazon's distribution network or Walmart's purchasing power, or access to a unique resource. When you analyze a company, your job is to play the devil's advocate. Attack it. Imagine you have unlimited capital, and you want to compete with this business. How would you do it? If you look at the company, and you can't find a realistic way to breach its defenses because of one or more of these 4 pillars, you may have found a wonderful business. This blueprint moves you from a passive stock picker to an active business analyst. It provides the intellectual foundation required for the buy-and-hold investment strategy to succeed. Without this analysis, buy and hold is just buy and hope. Now let's look at the antithesis, the trap that the 99% fall into time and time again. This is the allure of the story stock. Most investors don't use a rigorous framework like the 4 pillars. They buy narratives. They get excited about a company that is going to change the world with a new, revolutionary technology. The story is often compelling, futuristic, and easy to understand on a superficial level. It could be an electric vehicle company with a charismatic CEO, a biotech firm with a promising but unproven drug, or a software company riding the latest buzzword like AI or the metaverse. The problem is that a great story is not the same as a great business. A great business has a moat. A story stock often has nothing but a good story. The 99% fall in love with the narrative without ever asking the hard questions. What are the switching costs? Are there network effects? Does this company have any real, durable cost advantage, or can a competitor with more money replicate their technology tomorrow? They mistake temporary hype for a permanent competitive advantage. Consider the dozens of dot-com darlings from the late 1990s. Companies like Pets.com had a great story. They were going to revolutionize the pet supply industry, but they had no moat. They had no cost advantage over brick-and-mortar stores, no significant switching costs, and no network effect. They had a great story, a Super Bowl ad, and a sock puppet mascot. And then they went bankrupt. The investor who bought the Pets.com story lost everything. The investor who at that same time owned a boring company like Coca-Cola with its massive brand moat, or Moody's with its regulatory and reputation-driven moat in the bond rating business, sailed through the crash and continued to compound their wealth for decades to come. The path to mediocre returns, and often to catastrophic losses, is paved with exciting stories that lack economic substance. The millionaire mindset is not seduced by stories. It is convinced by moats. This is the fundamental difference in stock analysis that leads to wildly different long-term outcomes. The presence of a deep and wide economic moat is not just a qualitative feeling, it translates directly into superior financial performance that can be measured. The ultimate quantitative indicator of a wonderful business is a consistently high return on invested capital, or ROIC. This is the direct financial connection. ROIC tells you how efficiently a company is using its capital to generate profits. Imagine a company has $10 million in capital invested in its business, factories, equipment, inventory. If it generates $2 million in operating profit that year, its ROIC is 20%. This means for every dollar the company invests in itself, it gets 20 cents back in profit each year. A business that can consistently generate a high ROIC, say above 15 or 20%, without using a lot of debt, is a truly special enterprise. It is a hyper-efficient compounding machine. A low ROIC business, by contrast, is like trying to run in quicksand. It has to constantly invest huge sums of new capital just to stand still or grow modestly. A high ROIC business is like a rocket ship. It produces so much cash that it can fund its own growth and still have tons of money left over to return to shareholders through dividends and buybacks or to acquire other businesses. When you find a business with a strong moat that is also producing a high return on invested capital, you have found the holy grail of long-term investing. This is the financial fuel that powers the exponential compounding we talked about earlier. The moat protects the high returns from competitors, and the high returns provide the cash to reinvest and grow, which in turn strengthens the moat. It's a virtuous cycle. Your job as a long-term investor is to find companies caught in this cycle and then simply stay out of the way. When you look at your portfolio, don't just look at the stock prices. Look at the underlying ROIC of the businesses you own. Is it high and stable, or is it low and erratic? This single metric can tell you more about the quality of your portfolio and your prospects for long-term portfolio growth than almost any other number. It is the quantitative proof that you have successfully identified a wonderful business worth holding forever. We have established the necessity of finding a wonderful business and the mathematical imperative of letting it compound. But between the brilliant analysis and the glorious long-term result lies a battlefield, a treacherous 30-year expanse of time filled with market crashes, recessions, political crises, and terrifying headlines. The third pillar is therefore the most difficult to master: winning the psychological warfare of holding. This is where fortunes are truly made or lost. It's not about intellect. It's about temperament. It requires a level of emotional fortitude that few possess. To understand this battle, we must go to one of its most extreme examples: Warren Buffett's experience with American Express during the Salad Oil scandal of 1963. At the time, American Express was not primarily a credit card company. A huge part of its business was in warehousing and issuing receipts against stored goods. A company called Allied Crude Vegetable Oil borrowed heavily from banks, securing the loans with American Express receipts for giant vats of salad oil it supposedly had stored in Amex's warehouses. The problem was, the vats were mostly filled with seawater, with just a thin layer of oil on top. When the fraud was discovered, Allied Crude went bankrupt, and the banks that had loaned it money came knocking on American Express's door, demanding to be made whole. The market panicked. Wall Street assumed that the liabilities from the fraud would bankrupt American Express. The stock collapsed, falling by over 50%. It was a bloodbath. Investors, gripped by fear and uncertainty, were dumping the stock as fast as they could. This is the moment where most investors fail, but Buffett did something different. He didn't panic. He didn't sell. He got to work. He knew the market was reacting to the headline, to the fear of the unknown liability. But he wanted to understand the reality of the underlying business. He was less concerned with the potential one-time loss from the salad oil fraud and more concerned with the ongoing health of the core businesses, the traveler's checks, and the relatively new credit card business. So he engaged in what is now famously called scuttlebutt research. He went out into the real world. He visited restaurants and banks. He talked to merchants. He talked to their competitors. He asked them, "Are you still accepting American Express cards? Are you still using their traveler's checks?" And the answer he got over and over again was a resounding yes. People's trust was in the American Express brand, and that trust was unshaken. The fraud was seen as an isolated incident in a peripheral part of the business. Buffett concluded that the company's economic moat, its powerful brand, and the trust it commanded, was completely intact. He calculated that even in a worst-case scenario, the salad oil losses were manageable, and the fundamental earning power of the real business was being valued at practically nothing. So in the face of absolute panic, he did the opposite of the crowd. He invested 40% of his investment partnership's entire capital into American Express stock. It was the single largest investment he had ever made. He bet the farm, and he was right. The company weathered the storm, the stock recovered, and then soared. The investment was a massive home run that supercharged the returns of his partnership. The lesson here is monumental. Winning the psychological war is not about being emotionless. It's about channeling your emotions into productive action. Instead of fear-driven selling, he used his concern to fuel fact-finding. He separated the temporary, solvable problem from the permanent, durable business reality. This is the essence of the millionaire mindset in action. What Buffett was fighting against in 1963 are two of the most powerful and destructive cognitive biases that plague investors: loss aversion and the availability heuristic. Understanding these is critical to building your psychological defenses. Loss aversion, first identified by psychologists Daniel Kahneman and Amos Tversky, is the principle that for human beings, the pain of losing is psychologically about twice as powerful as the pleasure of gaining. Losing $100 feels as bad as gaining $200 feels good. This is a survival mechanism. On the savannah, ignoring a potential threat, a loss, was far more dangerous than missing a potential opportunity, a gain. But in the stock market, this wiring is catastrophic. When a stock you own drops 20%, the pain you feel is disproportionately intense. Your brain's ancient survival instinct screams, "Danger, threat, make the pain stop." And the easiest way to make the pain stop is to sell the stock. This is the biological impulse behind panic selling. You are not selling because your long-term thesis is broken. You are selling to numb a primal psychological wound. The second bias, the availability heuristic, is our tendency to overestimate the likelihood of events that are more recent, more frequent, and more emotionally charged in our memories. When the market is crashing, the news is filled with terrifying headlines, images of panicked traders, and comparisons to 1929 or 2008. These vivid, emotionally potent images are highly available to your brain. Your mind concludes that a catastrophic permanent loss is not just possible, but highly probable. It ignores the statistical reality that over the long term, markets have always recovered and gone on to new highs. It focuses instead on the immediate available and terrifying story being told right now. Together, loss aversion and the availability heuristic form a toxic cocktail of fear. They compel you to sell at the precise moment of maximum pessimism, the point of greatest long-term opportunity. Overriding these deep-seated impulses is not easy. It requires more than willpower. It requires a pre-planned system, a rational process that you can deploy when your emotional brain is trying to hijack your decisions. This is where we need an applied mental model, a practical tool to force rational thought in the heat of battle. Let's call it the Stoic Investor's Journal. This is a physical or digital journal. You start the day you purchase a stock for a long-term hold. This is a crucial step in your personal asset management. In your first entry for that stock, you will write out, in detail, your complete investment thesis. You will answer a series of questions. Why am I buying this business? What is its durable competitive advantage, and which of the 4 pillars does it fall under? What are the key metrics I will use to track its performance, like ROIC or revenue growth? What are the biggest long-term risks to this business? And most importantly, under what specific conditions would my thesis be proven permanently broken? You must be specific. The stock going down is not an acceptable answer. An acceptable answer would be, my thesis is broken if the company's primary patent is invalidated by the courts. Or, my thesis is broken if a new technology emerges that makes their core product obsolete. Or, my thesis is broken if they lose more than 10% market share to their main competitor for 2 years in a row. You write this all down when you are calm, rational, and objective. You close the journal and you put it away. Now fast forward a year or two. The market is in turmoil. A geopolitical crisis has erupted, interest rates are spiking, and your stock is down 35%. The fear is palpable. Loss aversion is screaming in your ear. The availability heuristic is flashing images of the Great Depression in your mind. You feel an overwhelming urge to sell. Here is the rule of the Stoic Investor's Journal. You are forbidden from selling a single share until you perform a specific ritual. You must take out the journal, turn to your original entry, and read your entire thesis out loud if necessary. Then, you must write a new entry, dated for today. In this new entry, you must argue, using facts and evidence, not emotion, why one of the thesis-breaking conditions you previously laid out has been met. You must prove to your former rational self that the fundamental long-term story of the business has been permanently impaired. If you cannot do this, you are not allowed to sell. This simple process acts as a circuit breaker. It forces a pause. It shifts you from your emotional, reactive brain to your analytical, logical brain. 9 times out of 10, you will find that the reason the stock is down is because of some macroeconomic fear or short-term issue, not a fundamental breakdown in the business itself. The journal becomes your anchor to rationality in a sea of emotional chaos. It is the single best tool for developing the fortitude that separates the successful long-term investor from the panicked crowd. The alternative to this stoic, disciplined approach is the path followed by the 99%. They become slaves to Mr. Market. This is the famous allegory created by Benjamin Graham and championed by Buffett. Imagine you are business partners with a man named Mr. Market. Every day, he shows up at your door and offers to either buy your shares in the business or sell you his, at a specific price. The key thing to remember about Mr. Market is that he is a manic depressive. Some days, he is euphoric. He sees nothing but a rosy future and offers to buy your shares at a ridiculously high price. Other days, he is inconsolably pessimistic. He is convinced the world is ending and offers to sell you his shares for pennies on the dollar. The 99% of investors let Mr. Market be their master. If he shows up euphoric and prices are high, they get swept up in his excitement and buy more, often at the peak. If he shows up depressed and prices are collapsing, they absorb his fear and panic, selling their shares to him at the very bottom. They allow the daily mood swings of this irrational partner to dictate their actions. The wise investor, the one with the stoic journal, treats Mr. Market as a servant, not a guide. They know his quotes are not a reflection of the true value of the business, but merely a reflection of his current emotional state. They are happy to ignore him for days, weeks, or even years at a time. But when he shows up in a deep depression, offering to sell his shares at a foolishly low price, they are prepared to take advantage of his folly and buy from him. And when he shows up in a fit of euphoria, offering a price that far exceeds the business's intrinsic value, they might consider selling a piece of their business to him. The key is that the decision is always theirs, based on their own analysis of the business's value, not on Mr. Market's emotional whim. The 99% are glued to the ticker, reacting to the manic screams and depressive whispers of Mr. Market. This guarantees they will buy high and sell low. It is a path of guaranteed mediocrity and, for many, financial ruin. The ability to ignore Mr. Market's daily chatter is a superpower in the world of investing. The financial consequence of succumbing to this psychological warfare is what we can call the volatility tax. This isn't a tax you pay to the government. It's a financial penalty you impose upon yourself for bad behavior. When you panic and sell during a downturn, you are doing 2 profoundly destructive things to your long-term wealth-building plan. First, you are crystallizing a temporary, on-paper loss into a permanent, real loss of capital. A stock that is down 30% is a recoverable situation. A portfolio that has been sold for a 30% loss is a permanent impairment of your capital base. You now have to generate a much larger percentage gain on a smaller amount of capital just to get back to even. Second, and even more destructively, you are almost certain to miss the market's best recovery days. Study after study has shown that the market's best days tend to happen in very close proximity to its worst days, often during periods of extreme volatility and fear. By selling and moving to the sidelines to wait for the dust to settle, you almost guarantee that you will miss the explosive rebound. The cost of this is staggering. Data from firms like J.P. Morgan Asset Management has shown that if you had stayed fully invested in the S&P 500 over a 20-year period, your returns would have been significantly higher than if you had missed just the 10 best days in the market over those 2 decades. Missing just those 10 days could cut your total return by more than half. Missing the 20 or 30 best days could result in a return close to zero or even a loss. This is the volatility tax. It is the massive, irreversible damage you do to your long-term compounding rate by succumbing to fear and trying to time the market. The fortitude to hold on through the downturn is not just a matter of psychological comfort. It is a matter of mathematical necessity. It is the price of admission for earning the spectacular long-term returns that the stock market offers. If you cannot pay that price, you will inevitably pay the far higher price of the volatility tax. We arrive now at perhaps the most deeply ingrained and most destructive piece of conventional financial wisdom, the idea that you should take profits. You'll hear it from financial news anchors, from your friends, from your own inner voice. You'll never go broke taking a profit. It sounds so prudent, so sensible, and it is the very idea that will keep you from ever becoming truly wealthy. This is the fourth pillar of our philosophy, understanding and utterly rejecting the fallacy of taking profits. It is the active decision to cut your flowers and water your weeds, a mistake that even a young Warren Buffett made, and a lesson he learned so painfully that it reshaped his entire approach to portfolio management. In the mid-1960s, Berkshire Hathaway, still primarily a struggling textile company, bought a significant stake in Walt Disney. Buffett had met Walt Disney personally, admired his creative genius, and understood the immense, untapped value of the company's film library and brand. He bought the stock at a price that valued the entire company at around $80 million. To put that in perspective, a single movie from that library, Snow White, was worth that much by itself. It was a classic Buffett investment, a wonderful business at a fair price. Soon after, the stock price rose by about 50%. A young, and not yet fully formed, Buffett decided to sell. He locked in a nice, quick profit for his shareholders. It was a smart, tactical trade. And it was one of the biggest financial blunders of his career. He watched in the following years as Disney's stock didn't just go up a little more, it exploded. That $80 million company he had sold out of would, over the next few decades, become a global media empire worth hundreds of billions of dollars. The profit he left on the table was not just 100 or 200%, it was tens of thousands of percent. That single decision to take profits cost his shareholders billions upon billions of dollars in future wealth. It was a lesson he never forgot. He would later describe this type of behavior with a perfect, devastating metaphor. The weeds wither away in significance as the flowers bloom. Over time, it takes just a few winners to work wonders, and yes, it helps to start early and live into your 90s as well. But my activity in cutting the flowers and watering the weeds was not a recipe for success. This is the core of the problem. Your portfolio is like a garden. In it, you will have some plants that grow spectacularly well. These are your big winners, your wonderful businesses. You will also have some that wither or get eaten by bugs. These are your mistakes, your losing investments. The act of taking profits is the equivalent of walking into your garden and cutting down your most vibrant, fastest-growing flower, simply because it has grown tall. You then take the water and nutrients you would have given that flower and spread them around on the struggling weeds, hoping they might recover. It is an act of profound horticultural and financial insanity. The entire game of long-term investing is to find those few spectacular flowers and let them grow into giant trees that dominate the garden and provide shade and fruit for a lifetime. Selling them early is a guarantee of a mediocre garden and a mediocre financial future. The psychological impulse to commit this error is driven by a powerful cognitive bias known as the disposition effect. This is a specific, well-documented phenomenon where investors have a strong tendency to sell assets that have increased in value, while holding on to assets that have dropped in value. We are eager to sell our winners, but incredibly reluctant to sell our losers. Why do we do this? It comes down to two powerful emotions, pride and regret. When we sell a stock for a profit, we get a jolt of pride. We feel smart. We have won the game. That realized gain is a validation of our skill. It feels good, and we are wired to seek out things that feel good. On the other hand, selling a stock for a loss is an admission of failure. It forces us to confront the fact that we made a mistake. This triggers a powerful feeling of regret. To avoid that painful feeling, we hold on to the losing stock, telling ourselves it will come back. We avoid crystallizing the loss because doing so would crystallize the regret. So we sit there, holding a portfolio full of our mistakes, our weeds, while having sold off all of our successes, our flowers. The disposition effect systematically creates a portfolio designed for underperformance. It is a factory for producing mediocrity. You end up with a collection of businesses you were wrong about, and a track record of small, insignificant profits from the businesses you were actually right about. The key to overcoming the disposition effect is to completely reframe the emotional equation. You must learn to feel pride not in taking a small profit, but in having the discipline to hold a great company. You must learn to view the selling of a loser not as an act of regret, but as a smart, unemotional business decision to free up capital from an underperforming asset and redeploy it into a better one. You have to divorce your ego from your investment decisions. The market does not know or care what you paid for a stock. All that matters is its future prospects. The disposition effect ties you to the past, forcing you to make decisions based on historical purchase prices rather than future business potential. It is a psychological prison, and breaking out of it is a prerequisite for achieving financial independence. So if we're not supposed to sell our winners, what should we be doing? The alternative mental model is not passive inaction. It is an intelligent, active process of portfolio pruning. This is the blueprint for managing a concentrated portfolio of wonderful businesses for the long run. The core principle is this: instead of selling what has gone up, you should periodically, perhaps once a year, force yourself to sell your worst business. You review every company in your portfolio and ask yourself a brutal question. If I were starting with all cash today, which of these businesses would I be least excited to buy? Or, which of these businesses has shown the most evidence that my original thesis was flawed, or that its economic moat is eroding? You identify your weakest link, the most pathetic-looking weed in your garden, and you sell it. You take 100% of the proceeds from that sale, and you redeploy that capital into your single best business. You add to the position in the company that has the strongest moat, the best management, the most proven track record of execution. In short, you cut the weeds, and you give more water and sunlight to your strongest flower. This is the direct opposite of the disposition effect. It is a disciplined, rational system for continuously improving the quality of your portfolio over time. It forces you to regularly confront your mistakes and rewards your successes with more capital. This is an investment strategy that creates a powerful, positive feedback loop. Your best ideas get more of your money, increasing their impact on your overall portfolio growth. Your worst ideas are eliminated, freeing up capital that was being wasted. Over years and decades, this simple pruning method will transform your portfolio from a random collection of stocks into a highly concentrated portfolio of elite, world-class businesses. It takes courage, because it often means selling something at a loss, admitting a mistake, and buying more of something that has already gone up significantly, resisting the urge to take profits. But it is the single most effective strategy for ensuring that your portfolio's returns are dominated by your best ideas, which is the only way to build life-changing wealth. This portfolio pruning model stands in stark contrast to the common dogma of rebalancing. Many financial advisors and asset management professionals preach the gospel of automatic rebalancing. The idea is that if a particular stock or asset class grows to be too large a percentage of your portfolio, you should sell some of it and reinvest the proceeds into your underperforming assets to bring your portfolio back to its original target allocations. On the surface, this sounds like a prudent risk management technique, and for a broadly diversified portfolio of mutual funds or ETFs, it can be. But for an investor seeking to build serious wealth through the ownership of a concentrated portfolio of wonderful businesses, it is often a catastrophic mistake. Automatic rebalancing is a formula for mediocrity. It is a system designed to punish excellence. Every time one of your businesses performs exceptionally well, the rebalancing rule forces you to sell it. It is, by definition, cutting your flowers. It takes the capital from your best performer and reallocates it to your laggards. It is a forced implementation of the disposition effect. Warren Buffett never became the richest investor in history by rebalancing. When Coca-Cola grew to be a massive percentage of his portfolio in the late 1980s and 90s, he didn't trim it, he celebrated it. He understood that his portfolio's success would ultimately be determined by one or two of these massive winners. To sell them simply because they were doing well would be to abandon the very engine of his wealth creation. Rebalancing is a strategy for diversification. And as Buffett has famously said, diversification is protection against ignorance. It makes very little sense for those who know what they're doing. If you have done the hard work of identifying a truly wonderful business, why would you want to sell a piece of it to buy more of a business you are less confident in? The path of the 99% is to diversify and rebalance their way to average returns. The path to extraordinary wealth is to intelligently concentrate and let your winners run. The direct financial connection here is one of the most powerful laws in all of economics and finance, the power law distribution, also known as the Pareto principle or the 80-20th rule. In any system with creative or competitive outcomes, be it book sales, movie profits, venture capital returns, or a stock portfolio, the vast majority of the success will be concentrated in a tiny minority of the participants. A handful of authors sell millions of books, while most sell very few. A few blockbuster movies generate most of the industry's profit. And in your stock portfolio, a small number of investments, perhaps just 1 or 2 out of 10, will likely generate 80% or more of your total long-term returns. This is not a theory, it is a mathematical reality. The entire game of long-term investing can be summarized as this: identify and own one of these mega winners for a very, very long time. Your financial success will not be determined by the average return of all your stocks. It will be determined by the massive outlier return of your single best investment. The act of taking profits after a stock has doubled or tripled is a guaranteed way to ensure you never, ever hold a mega winner long enough for it to work its magic. A stock that goes up 10 times in value must first go up 2 times, and then 3 times, and so on. By selling at the 2 times mark, you forfeit the remaining 8-fold increase. You have exited the power law lottery just as your ticket was being called. The financial implication is stark and brutal. If you systematically sell your best performers, you are systematically eliminating the very possibility of achieving life-changing wealth. Your portfolio will be doomed to a lifetime of mediocrity, consisting of the discarded scraps of your past successes and the lingering ghosts of your past failures. Understanding the power law is the final piece of financial education needed to immunize yourself against the siren song of taking profits. It proves, mathematically, that holding your winners is not just a good idea, it is the only idea that truly matters. This brings us to the final, unifying pillar. It is the culmination of all the previous principles: the understanding of compounding, the analysis of wonderful businesses, the psychological fortitude, and the rejection of profit-taking. It is a complete shift in identity. It is the transformation from a trader playing a game of stocks to an owner building a business empire. This is the 5th pillar, adopting the owner's mindset versus playing the trader's game. This is the ultimate key to unlocking the full potential of the buy-and-hold investment strategy. Nothing embodies this mindset more than Buffett's acquisition of the Nebraska Furniture Mart in 1983. This was not a stock purchase. It was the purchase of an entire business, and the story behind it reveals everything about his philosophy. The company was founded by Rose Blumkin, a Russian immigrant who arrived in America unable to read or write English. She started the business in a basement with a $500 loan, and through sheer force of will and an obsessive focus on customer value, sell cheap and tell the truth, she built it into the largest and most profitable home furnishing store in the country. By 1983, it was doing over $100 million a year in sales. Buffett had admired Mrs. B, as she was known, for decades. He saw in her the ultimate owner-manager, ferociously competitive, pathologically honest, and totally devoted to her business. One day he went to see her. He was so confident in her and the business she had built that he made an offer to buy the company without ever looking at its books or conducting a formal audit. He bought it based on his assessment of the character of the owner. As the story goes, he asked her for a price. She named a figure around $60 million. He said, "I'll take it," and they sealed the deal with a 2-page contract and a handshake. He was not buying inventory and a building. He was buying Mrs. B. He was becoming a partner in the business she had poured her life into. After the sale, he asked her to stay on and run the company, which she did, working well past her 100th birthday. This anecdote is the purest expression of the owner's mindset. Buffett saw himself as acquiring a piece of an extraordinary enterprise run by an extraordinary person. He wasn't thinking about the next quarter's earnings or an exit strategy. He was thinking about the next 50 years. This is the mindset you must adopt with your own stock market investments. You are not buying a ticker symbol. You are buying a fractional share of a real business, run by real people. Your job is to select the best businesses run by the best people, and then act as a silent, patient, long-term partner. The psychological mechanism at play here is known as the framing effect, combined with the power of identity-based habits. The framing effect demonstrates that how a choice is presented to us radically influences our decision. If you frame your stock market activity as playing the market or trading stocks, you will naturally adopt a short-term competitive game-like mentality. Your goal will be to outsmart other players, to predict the next move, to win the game today. Your identity will be that of a trader. However, if you frame your activity as investing in businesses or becoming a part owner of great companies, your entire psychology shifts. Your identity becomes that of a business owner. As a business owner, your concerns are completely different. You think about long-term strategy, competitive positioning, management quality, and capital allocation. You don't get spooked by a 10% drop in your company's stock price any more than a farmer gets spooked by a cloudy day. You're focused on the long-term health and productivity of your asset. By consciously adopting the identity of a business owner, long-term holding ceases to be a struggle that requires constant willpower. It becomes the natural, default behavior. Owners don't sell their successful, profitable businesses every time they get a good offer. They hold on to them, nurture them, and let them compound in value for their family and future generations. James Clear, in his book Atomic Habits, explains that the most powerful way to change your behavior is to change your identity. Don't try to force yourself to hold stocks longer. Instead, start to see yourself as a long-term business owner. This subtle shift in self-perception will automatically align your actions with your goals, making the disciplined, patient approach feel like the most natural thing in the world. To cultivate this owner's identity, you need a practical tool for evaluating the people who are running the businesses you plan to partner with. This is our final blueprint, the CEO letter litmus test. Before you invest in any company, you must go to its investor relations website and read at least the last 5 to 10 years of the CEO's annual letters to shareholders. This is your interview with your potential business partner. As you read, you are not looking for financial projections. You are looking for character and mindset. You need a checklist of green flags and red flags. Green flags include: does the CEO talk like a partner, using words like "we" and "our company"? Are they candid and upfront about mistakes and what they learned from them? Do they focus on long-term metrics like growing intrinsic business value, ROIC, and strengthening the company's moat? Do they explain their capital allocation decisions clearly, as if they were explaining them to a knowledgeable family member? Do they write clearly and simply, avoiding jargon? Red flags include: does the CEO talk like a stock promoter, constantly hyping the stock price and using empty buzzwords? Do they blame all problems on external factors and take credit for all successes? Do they focus obsessively on short-term quarterly earnings and meeting Wall Street's expectations? Do they use accounting that seems designed to obscure rather than clarify? Is the letter filled with boilerplate corporate speak? Reading a decade of these letters will give you a profound insight into the mind and character of the person stewarding your capital. You will quickly learn to distinguish the true business builders like a Jeff Bezos in his early Amazon letters from the short-term-oriented managers just trying to hit their bonus targets. This litmus test transforms stock picking from a numbers game into an exercise in judging character and long-term vision. It is the ultimate tool for adopting the owner's mindset and ensuring you are partnering with people who share your long-term philosophy. The antithesis of this owner's mindset is the world in which the 99% of market participants live. It is the world of the analyst upgrade/downgrade cycle. This is the trader's game, a frantic spectacle created by and for Wall Street. Every day, analysts from major investment banks issue buy, sell, or hold ratings on stocks, along with 12-month price targets. The financial media then amplifies these calls, creating a flurry of activity. A stock gets an upgrade, and it pops 5%. It gets a downgrade, and it drops 8%. The 99% are trapped in this ecosystem. They buy because a well-known analyst said, buy. They sell because that same analyst downgraded the stock to hold. They are outsourcing their thinking to people whose incentives are not aligned with their own. Wall Street analysts are not in the business of helping you build long-term wealth. They are in the business of generating trading commissions for their firms and creating compelling stories to justify their salaries. Their long-term view is often just the next 12 months. This game has nothing to do with the intrinsic value of the underlying business. A company's economic moat doesn't disappear overnight because an analyst changed their mind. Its ROIC doesn't collapse because of one disappointing quarter. But the trader's game is not concerned with these things. It is a game of chasing momentum, of reacting to news, of trying to guess what other people will think other people will think. It is a noisy, expensive, and ultimately zero-sum distraction from the real work of wealth creation. The business owner ignores this game completely. They know that the daily chatter of upgrades and downgrades is just Mr. Market having another one of his mood swings. They are focused on the annual report, not the analyst report. They are playing a different game on a different time horizon with a different set of rules. And that is why they are destined to win. Finally, we must connect this owner's mindset to its most significant and tangible financial benefit. The government and the tax code are practically begging you to adopt this philosophy. There is a giant thumb on the scale, a massive, legally sanctioned advantage given to long-term owners over short-term traders. This is the difference between long-term and short-term capital gains tax rates. Let's run the numbers, because this is the final irrefutable argument for the buy-and-hold investment strategy. In the United States, if you buy a stock and sell it for a profit in less than a year, that profit is considered a short-term capital gain. It is taxed at your ordinary income tax rate, which for high earners can be as high as 37% plus state taxes. If, however, you hold that same stock for more than a year before selling, your profit is considered a long-term capital gain. It is taxed at a much lower preferential rate, which is typically 15 or 20% for most people. Let's consider two investors, each starting with $100,000 and each earning a 20% pre-tax return per year for 30 years. Investor A is the trader. They successfully make 20% each year, but they do it through active trading, so their gains are always short-term. They pay a 35% tax on their profits each year. Investor B is the owner. They find a wonderful business that compounds at 20% per year, and they don't sell it for 30 years. At the end of 30 years, they finally sell and pay a one-time long-term capital gains tax of 20%. We already saw the pre-tax difference between these two was enormous. But now let's look at the after-tax reality. Investor A, the trader, after 30 years of paying taxes along the way, ends up with about $1.4 million. Investor B, the owner, whose pre-tax sum was $23.7 million, pays their one-time 20% tax bill of roughly $4.7 million. They are left with $19 million, $19 million versus $1.4 million. That is the power of tax-deferred compounding combined with the preferential long-term capital gains rate. The tax code provides a multi-million-dollar incentive to think and act like an owner, not a trader. Every time you sell a great business after just a few months or a year, you are not just resetting your compounding clock. You are voluntarily choosing to give the government a far larger share of your success. The single most powerful tool for wealth building is right there in the tax code, available to anyone with the patience and discipline to use it. It is the government's final seal of approval on the wisdom of Warren Buffett. You have just absorbed a complete mental framework for wealth generation. This isn't just a tip or a tactic. It is a fundamental shift in philosophy, the very principle that allowed Warren Buffett to compound a small sum into one of the world's greatest fortunes. You now understand that the real source of life-changing wealth is not found in the frantic activity of trading, but in the profound and powerful act of holding. You have the blueprint to identify wonderful businesses, the psychological tools to withstand the storms of market volatility, and the clear-eyed understanding of why taking profits is a siren song for mediocrity. You now possess the owner's mindset, the single most critical identity for anyone serious about achieving true financial independence. But mastering this principle, as powerful as it is only one half of the equation. A compounding machine, no matter how powerful, is useless if it is built on a faulty foundation. Warren Buffett's system is a network of interconnected mental models. The principle of holding your winners is the offense. It is how you score the points needed to win the game. But as any champion will tell you, championships are won by defense. Before you can let your flowers grow, you must first ensure that your garden is protected from the plagues that can wipe it out before it has a chance to flourish. The video that is now appearing on your screen is the other half of this equation. It represents the missing link. It is the defensive playbook. It is the set of mental filters and rules for avoidance that act as the unbreakable guardian of your capital. Knowing what to do is powerful. Knowing what not to do is where invincibility is forged. Amateurs focus on making money. Professionals focus first and foremost on not losing it. The choice of which you want to be is defined by what you do next. To complete your arsenal, to connect the offensive strategy you've just mastered with the defensive strategy that protects it, the path forward is right there on the screen. The journey to complete your mental map continues with your next click.